Welcome, ladies and gentlemen, from me, Guy Munson, to our regular 6-minute strategy summary. I'm going to talk this week about the speech made, albeit virtually, by Chairman Jerome Powell of the Federal Reserve to the Kansas City Fed seminar at Jackson Hole. This is really the world's premier gathering of central bankers, academics, finance ministers that's occurred in the mountains right back to 1978. Chairman Powell was giving the results of the 2019 review, or begun in 2019 review, of monetary policy by the Federal Reserve. And his conclusions are very significant, both for monetary policy and, in my view, for financial markets. He confronted really four issues which are problems right across the world. The first one, growth rates have been declining in the US and globally. Secondly, interest rates have been touching new lows in the US and around the world, negative across much of Europe and Asia, and towards the zero bound in the US. Three, despite this, there is good news. And that good news is that at least up until the COVID crisis, unemployment was at lows we couldn't have dreamt of. And encouragingly, a lot of those labour market benefits were distributed very widely across society, particularly to the poorer income groups. Fourth, of course, this low unemployment level did not trigger a rise in inflation. In fact, inflation has been consistently falling. On the right-hand chart, Chairman Powell reminded us that the last big Fed review in 2012 under Janet Yellen, they set a target for inflation of around about 2%. And you can see on this right-hand chart, these coloured lines show the projections of those inflation levels and the actual outcomes. And in every case, the Federal Reserve, the solid line, and a survey of professional forecasters in a dotted line always overestimated inflation. It kept coming in below target. You can see that in another way, that while the unemployment rate on the left fell sharply until, of course, COVID and the large rebound we've seen, the inflation rate, and the Fed prefers what it calls the core measure, the inflation rate sat below the 2% target, the dotted line target, almost all the time since 2000. Has actually averaged just 1.7%. So we've continuously undershot. And that's quite a dangerous position as the world slows down so dramatically with this sharp second quarter collapse in growth. So what did the Federal Reserve change? Well, remember, they're under a mandate from Congress to target price stability and full employment. How they do that is down to the Fed's independence, and they're going to make some changes. First of all, rather than targeting a strict 2%, they're going to target 2% over time, which means that if they're below inflation at one period, they can afford to be above inflation at another period. So it could be quite normal for inflation to run 2–2.5% without the Federal Reserve acting. They haven't given any formulaic numbers. We don't know what tolerances there are. It'll be not dictated by any formula. So we're back to Fed watching, but it's a big change. On employment, they indicated that rather than looking at deviations of employment from a maximum level, they're going to look at shortfalls. Now that looks like a small change of language, but it's significant because it shows that maximum employment, in their view, is really beneficial from a societal basis. It's good for the poorer, it's good for the middle poor and middle income groups. They particularly in their text emphasised how pleased they were to see the employment differentials between black and Hispanic groups coming much closer to white groups, so the racial deviations lessening, if you like. So there's a really powerful societal aim here. So what are my conclusions? One, Chairman Powell was definitely dovish. He's got a higher tolerance for inflation, but as many people asked and scratched their heads, how relevant is that today in the middle of the COVID crisis when inflation is well below target? The speech was significant. It came out earlier than expected, it was more forceful, and it was very pragmatic. Thirdly, I was particularly interested in his inclusive employment goal. In other words, this idea that there are societal benefits from really full employment. And I think this is a big social context, which for the first time is really coming into Chairman Powell's thinking, and I think will become a global phenomenon. So what does this mean for markets? Well, to an extent, Fed watchers have been anticipating this. You can see inflation expectations, which we looked at in these meetings regularly, creeping upwards to 181. The dollar there falling, obviously a more inflation-tolerant approach probably suggests a lower dollar. Note, though, that the 10-year bond yield has started to tick up, and indeed the curve has steepened. So there is some question mark for whether these ultra-low bond yields can persist. Now, I'm not talking about a sharp sell-off, but I think a slightly different view of bonds could emerge from these words. You can see this in the performance of asset classes for the 30th of June to date. That's the half year to date, just the last month and a half or so. Now, I don't normally look at such short-term periods, but look at these charts. Gold come down quite sharply, still up for the year. Equities rallying very strongly. UK gilts, so this will be the same for US Treasuries, come off sharply. So a big deviation between equities and bonds. And I think this is coming out of Powell's policy. And it may be that we see bond market volatility will continue to rise. Finally, it could suggest a change in equity market leadership. We saw the S&P 500 equally weighted index, that's the one that takes out the effect of these super cap tech stocks, rally sharply in the second quarter and then fall back. That could open up again. And perhaps we're seeing, at least for a period, a temporary high point in this extraordinary leadership of the growth technology stocks and the FANG index in particular. Facebook, Apple, Amazon, Netflix, Baidu, Nvidia, etc. So a significant speech, a socially significant speech, and one that has implications for stock market and asset leadership. Thank you.